Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. We appreciate you checking out the show. If you haven't done so already, please go take a look at the new and improved hardmoneymastermind.com. And also click on the tab Live Events. We're having our first annual summer meeting for members here in Maryland in June. Go check it out at hardmoneymastermind.com. All right, so today we're talking about a crucial part of this niche of lending, which is, working with repeat borrowers. And this is, for the most part, kind of exclusive to residential fix and flip or fix and hold, where you can lend to the same people over and over again so many times. To be honest, everyone knows that we love small balance commercial bridge lending, but this is one area where Resi's got an advantage over commercial, because as a commercial property owners, they aren't getting 5 bridge loans in a year. Like, it's just not happening. You know, like, it happens situationally when they need it and they're great, but they're not the kind of client you're going to do 5 deals a year for. Also, one point about that, when you think about something we've been focused on recently, is kind of revamping and increasing our marketing. And so when you do that, you're looking at cost per lead and costs to acquire a customer acquisition costs, right? And if you look at it on a month-to-month basis, you should be able to come out way in the positive. Like, if you're spending $5,000 a month in marketing and you close a deal or two that brings in $10,000, then you're way in the positive. But think about how it gets better when we're talking about another important metric, lifetime value of a customer. And all this stuff is kind of hard to put together and track in a business like ours. But conceptually, think about, if you acquire a customer this month through paid advertising, email marketing, whatever it might be, offline stuff, and you get to lend to them 10 times over the next 3 years. Like, how huge is that? How huge is that ROI if you spend $1,000, say, to acquire a customer, and you literally get to do 10 loans for them in the next 3 years? It's a home run. It's a home run, and a lot of businesses just don't have that kind of opportunity.
Yeah, it's huge. And we go into every deal with the assumption that we're going to do another loan or two for that particular borrower. Over 50% of our loans every month are repeat borrowers. And I think most folks in the Hard Money Mastermind group, it's the same thing, right? Like, it's repeat business. Now, listen, it might not be doing 20 deals a year for the same borrower. Probably don't want to do 20 deals a year for the same borrower, right? That's kind of a lot of exposure for one group. But getting a few deals from the same groups over and over and over, is a good thing. I remember having a conversation with our partner, one of our partners in the New Jersey market that we have an office in. And he was in startup phase. He was early on, and he was grinding through new deals and new borrowers over and over and over. And that's the game right at the beginning. But I'm like, listen, when this clicks is when those first-time borrowers turn into a second-time borrower, third-time borrower, fourth-time borrower. Because not only are you going to be doing, at that point he was probably doing like 2-3 deals a month, and he was starting to scale up, which was good. And it was one of those things where it's like, hey, listen, your volume is going to double after you get there, just based on repeat borrowers, right? Because, if 50% of your borrowers turn to repeat, you do 2 deals and then you're getting your 3rd deal. You do 4 deals, you're getting 2 more. You're getting into, 4 new deals, you're getting into 6 new deals. And that's really what catapulted it. And it takes, it can take maybe a few years to kind of build that up till that happens, but it turns into a beautiful thing. And there was a point internally in our business where I was only really working with our repeat people that I had relationships with. And some of our other, sales guys and partners were running all of the new stuff, because I had a book of business of repeat people that were coming in over and over and over and over. So let's talk about working with them and some do's and some don'ts, because one of the things that, and I've seen a few people post in the mastermind group about taking care of their current clients and potentially cutting costs and cutting fees and cutting it. And, that's an easy thing to, think about in order to take care of a borrower, but it's kind of not that recommended to do. You get kind of in a tough situation if you start cutting fees, because then you're going to have in the back of your head, well, first the borrower is going to think, well, if they cut these fees, they can cut other fees. And then you're also going to have that in the back of your head of like, oh, well, I cut these fees for this borrower. I'm going to cut fees for the next borrower. And next thing you go from a 13-3 lender to a 12-3 lender or a 13-2 lender. And then what's next? Okay, well, now I'm a 12-2 lender. And like over time, do the math. Like you go from 3 points to 2 points, you're just cutting 33% of your
big swing,
right? That's a big thing. Like it's kind of a fine line to play. And yeah, we know obviously you want to sell people on speed and flexibility and easiness and talk to the underwriter and start capital and stuff like that. And that's fine. That's good. I would try to not cut fees. Have we ever cut fees? Possibly here and there, but like, I would say, less than 1% of the time, like a very, very low case scenario. I would try not to go down that road if you can. I think there's other things that you could potentially provide value to besides cutting fees. And that's the easiest way to say it, right? Because anyone's going to be like, oh, can you cut this? So-and-so is giving me 12-2. I mean, and I don't want to say this was a hard decision because it wasn't. It might seem as an outside decision that it was a hard decision. But like we did 100 plus loans for one borrower over 5-6 years, right? Oh, like you don't think that he tried to beat us up over and over and over and over. And at one point he was like, listen, you can't give me higher leverage and cheaper terms, I'm out. And this was also kind of when institutional capitalists came in. So he diverted to that. And I'm like, the value I can bring. I'm getting deals to the table for you in a day or two, as quick as you need. Our value is there. And it wasn't necessarily we weren't providing enough value to them. We were providing enough value to them. You're not going to win every deal. You're not going to keep every borrower. Some borrowers in general will outgrow this model. It'll outgrow your service. There's a lot of folks that get institutional capital. Yeah, institutional capital is starting to dry up a little bit, and there's some challenges with that. So maybe some of those people divert back to you. But like, there's institutional capital, there's bank capital, there's lines of credit, there's their own cash, there's all the private lenders. Some of these bigger real estate investors, hate to tell you, they're going to grow out of your program, and they're going to go find other means to get capital from. And that's okay. The name of this game is finding opportunities and good borrowers over and over and over and over and over. So guess what happened? We didn't do his deals that year, whatever it was, 15, 20 deals over there. I mean, he was turning deals quick, like every 3 months. So like one thing we were worried about at that time was if we had too much exposure with him, but we'd only usually have a few deals on our books at any given time because he would close them so quickly. That being said, maybe we were a little scared at the time, like, oh, we're not going to get business from him anymore. But guess what? We got more business from new borrowers over and over and over. So that's kind of the mentality that you have to have is let's spend time on the marketing machine. And if borrowers outgrow your product, so be it. That's just the nature of it.
Yeah, that was some kind of run. Like we haven't had a run anywhere close to that. But we still do a good amount of repeat. I think, it feels to me like 50-50 is a pretty good split. If somebody has only repeat borrowers, that probably means you're not marketing, right? And if you don't have any repeat borrowers and they're all new, then that might be, a problem with the process. Clearly, borrowers aren't coming back because they aren't super happy with the product or the service in some way. So I don't know. It feels like 50-50 is a pretty good. I'm always keeping an eye on this stuff, through our different originators and offices and like how we track month to month on the pipeline. And, sometimes it seems like people are a little light on the repeat. All the names closing this month are new ones. And then it kind of swings back the other way, right? And all in all, company-wide, it does kind of balance out to that 50%. And I think that's a good place to be. I think that's a good goal for a lot of lenders out there.
Yeah, exactly. So let me kind of give you a little tip as well. And I know a lot of lenders want to be lazy about this, but and we did this starting out, we did this for years. All of our partners have done this as well. And I think this is important. If you're not at a point where the loan volume is where you want it to be, go out to your properties, meet your borrowers at your properties, stay in front of these borrowers, show them that you're personally working on some of these deals with them. Listen, most of the lenders that we know, us included, we're not striving to just do as many possible deals as possible. Like, we're not a mortgage company. Like, we're trying to do the least amount of deals and make as much money as we can, the highest profitability that we can be, right? Like, if you can make the same amount of money on 5 deals as you can as a institutional lender can make on 20 or 30 deals, do the 5 deals, right? You want to make as much, you want to make as much money as possible on some of these things, right? So like some of these tips I'm about to say shouldn't be unreasonable, right? Like, the goal should not necessarily, whatever, you can make your goal whatever you want, but like, the goal is not necessarily to just be a volume shop to do as much deals as possible. If you can do a few really big deals and make the money you want to make, by all means do that. That's a good spot. Figure that out yourself. So going out to the properties. So keep in mind, let's say you have a fix and flip investor. They buy a property. It has a $60,000 construction budget. You go out to the property up front, do a little valuation, meet the borrower, take a look, put your eyes on the property to see, the construction that needs to be done, things like that. So you meet, and this is the first time borrower with you. You meet the borrower out there, you talk to him, you build a relationship there. Well, guess what? He's doing 4 or 5 draws, 3, 4, 5 draws. Go out to the property every time. In 3 months, you're going to see that borrower 4 or 5 times. They're going to see you there. You're going to give them advice. They're going to ask you questions. Maybe they even give you a check to drop off a monthly payment. Maybe even bring a check to give them for a draw, right? This is, let's say you're newer and you don't have ACH set up and all that other stuff. Like, you're building a relationship with them. That's how we got so many good qualified borrowers up front, that we built real quality relationships with. Because I was out on site with them every day, on the road, looking at properties, meeting them, building relationships with them, coffee, lunch, whatever. Soon as we started growing and scaling, and I wasn't physically out there on site all the time with some of them, or Chris wasn't on site with them, because Chris did that with capital investors. It's the same process. He hand delivered checks to capital investors. Right? Before we were set up with ACH and other stuff, going out to a property isn't necessarily just for underwriting purposes. It's for building relationship purposes. And that's what it was about. And, Chris is out there meeting capital investors, giving them checks. It's like, hey, at the time, Chris was living in Bethesda and our office was, closer to Baltimore area and like Howard County. Well, guess what? He would pass 3 different of our capital investors' houses on the way home. Why not drop by there? 5:30. Hey, here's a check. And their spouse was there. Oh shit. Is Chris coming again? Is Santa Claus Chris coming again with some more money for us? Like,
delivering money.
You don't think that's impactful to them? Like, that's what it's about. We're in a society, we're in a day and age where like everything's just done digitally and it's like a faceless business, right? Like, it doesn't need to be, like, especially at the beginning. Listen, we're all about automating stuff. We're all about leverage. I get it. I'm talking about the folks that need help deal with deals, need help raising capital. Get on the streets and start building relationships, because that's what it's about. And us kind of being out there talking to borrowers on a regular basis. Guess what else happens when you do the final draw with somebody and they're about to list the house? By the way, do you have another property that you're looking to buy? Don't even give them the opportunity to shop around, because you're in front of them all the time. So right now, Dave in our office is doing that for our local office, right? He's out there, he's out there doing inspection valuation on the front end. He's doing all the construction inspections. He's bringing bandit signs with him that says, houses financed by hard money bankers, construction financing financed by hard money bankers. Put those in there. He's doing whatever he can to make the borrower's life easier on that. Yeah, he might not be dropping off checks or giving checks. He could, but we do all that electronically in ACH. Nobody wants a freaking check anyways. That's a pain in the ass for them to go to the bank or do it on their phone. So it's ACH.
Well, I mean, Dave's been going to some of his closings with his borrowers. Who in hard money does that?
Agreed.
Like, I mean, back in the mortgage days, yes, that was like a, kind of top level, like, customer service thing to do. But in private lending, in commercial lending, nobody's going to closings, and Dave was doing that. And I was amazed to hear that. I thought it was fantastic. Here's another tip too, another hack for furthering that relationship with repeat borrowers. Now, if you run your own real estate meetup, great. Invite people who apply for loans with you to yours. Now, I know that most people are not running their own meetups. We did for a while, kind of put on the shelf. So instead, ask your borrowers which meetups they go to, and then ask to attend as well. Good way to spend additional time with them, and you'll probably get introduced to other real estate investors they know. And they're like, oh, there's a private lender. He's coming out to this meetup group. Cool, right? And if you're doing that with a few different people, you'll be cued into a few different meetups, and be consistent seeing those people in that environment. You're going to get more business, 100% chance, right?
It's just like shopping around for a loan for borrowers is not what they want to do. And the good news is this: years ago, the difference between your terms and the institutional terms were very big, right? You're talking 13-3 for us, and 8-1 with Kiavi or whatever. That's not the case anymore. No. It's close enough that is not impactful enough for somebody to save a point. A point is not making or breaking, shouldn't make or break somebody. I'm not saying it never does. It might. And guess what? You might have a good borrower that you've done a bunch of deals for. They'll be like, hey, listen, these guys have been freaking soliciting me. I love working with you and I appreciate it, but like, it's going to be a point on every deal. It's 1% cheaper every deal. I'm doing, whatever, a deal a month, $300,000. It's $3,000 a month. Like it's real money. I appreciate your services, and that's fine, right? Like you don't have to. The goal of this isn't to have to keep every single person forever. And people are scared to lose borrowers. The answer is listen, I get it. The value we bring to the table. I'd like to keep you as a borrower. If it doesn't work out, it doesn't work out. We keep this situation easy. I could typically promise you that most of us, hopefully everybody listening and us internally, we keep the process very easy for the borrower. Very, 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 very easy. It's an easy process. It's very simple. It's very flexible. It's quick. And like, that's what you got to do going into these things. And if you lose a borrower, even if, you have a great product, at some point they might come back. Chances are they will. That other lender won't be as good as you, right? Like they won't. They just won't. And if you lose them, you lose them, and you replace them with somebody else. But do the heavy lifting, right? Like, don't just sit at your desk. If you're desperate to try to find more business, get out there and do it. Do it the old school way, because that's what it's about. And I know that we leave money and deals on the table every month because I'm personally not as proactive with doing that as I had in the past. And yeah, we have partners and people in my office that are doing some of that stuff, but it goes a long way. I mean, think about if the roles are reversed. Like, you don't even give the option for them to try to shop around. They don't need anyone to shop around. You're seeing them multiple times a month because they're doing construction projects and you're on site and you're giving them money. Keep it easy for them. Keep it easy for them.
All right, everyone, that is the pod for today. Moral of the story is spend time with your clients and turn them into repeat borrowers. Repeat borrowers is one of the things that make this business model so great. So definitely take advantage of it. Till next time, guys. And till the next podcast, we'll see everyone inside hardmoneymastermind.com.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.